welcome to the Deep Dive. Today we're tackling a lightning rod topic that sits right in your wallet: credit card interest rates. We received a stack of sources detailing a sudden major policy announcement that aims to completely reshape consumer debt and, well, the immediate, fierce, and rather dire warnings that came flying back from the financial industry in response.
It's more than just a political spat, you're right. This isn't about, adjusting a minor tax code.
Yeah.
This is about the fundamental mechanism of consumer lending in the United States. It forces us to ask, what is the true cost of credit and who should really bear the risk?
Exactly. You shared these documents with us, and you, our listeners, asked us to unpack the claims and the counterclaims surrounding a proposed 10% cap on credit card interest rates.
Yeah.
So our mission for this deep dive is threefold. First, we need to understand the profound motivation behind this move. Second, review the surprising details, or maybe more accurately, the stunning lack of detail of the announcement itself.
Right. The lack of detail is a huge part of the story.
And finally, we need to synthesize the specific economic risks and the incredibly polarized political reactions outlined in all the materials we have in front of us. Okay, so let's unpack this. The core event happened fast, according to the sources. So President Donald Trump announced late last week, specifically on Friday night, January 10th, 2026,
Right?
via his preferred platform, Truth Social, that he intends to cap credit card interest rates at 10% for 1 year. And he gave the industry almost no time to prepare, stating the restriction would be effective on January 20th.
And that time frame itself is one of the most remarkable details here. January 20th, I mean, that's the anniversary of his second inauguration.
It gives it a certain political weight for sure.
A specific political gravity, exactly. But beyond the symbolism, you have a major overhaul of the consumer financial system announced with, what is that, less than 10 days' notice.
It's incredible. And the sources show he wasn't backing down over the weekend. This was then followed up, notably, by additional comments on Sunday night threatening legal action against any companies that weren't compliant.
Which is just, it's fascinating. You see this collision between platform and policy, this move from a long-standing campaign promise, which, often just remains rhetoric,
Right.
to an imminent, let's be honest, legally uncertain mandate. And it was all communicated through a social media post, then backed up by a threat of federal legal force 2 days later.
So you have a policy with potentially seismic economic consequences announced unilaterally, with the teeth of legal action threatened, but absolutely no actual regulatory framework, no published executive order, and no clear implementation details.
None.
So we have this political mandate, but zero regulatory mechanism, at least as of the initial announcement. And that gap, that space between the intent and the implementation, that's where the entire financial industry lives.
And it suggests this isn't just a simple lowering of prices, it's a potential fundamental disruption to how credit risk is managed in the U.S.
A disruption.
That distinction you just made between a simple price reduction and a fundamental disruption, that is the core argument we have to dissect today. Because if this policy were to become law, it would fundamentally alter the relationship between hundreds of millions of consumers and their lenders.
Okay, let's start with the rationale then, the political thinking. Because you can't really understand the policy without grasping the source of the public anger it's trying to tap into. The president's stated motivation for the cap was visceral. It was to stop the American public from being, and this is a quote, ripped off by credit card companies, charging rates often between 20 and 30%, sometimes even higher.
And he used language that was explicitly political, claiming these high rates, quote, festered unimpeded during the previous administration. That sets a very clear political tone.
Oh, absolutely. It's consumer protection. It's market correction.
Framed as rescuing the average American from corporate predation.
And that tone is entirely understandable when you look at the economic backdrop. This intervention is proposed against a setting of historic and, frankly, staggering consumer debt. The sheer scale of what American families owe right now is the foundation of the political urgency.
Yeah, we have to stop and really digest the scale of this problem. It gives you the gravity for why a politician would propose a measure this radical. American credit card debt has been, well, exploding.
Exploding is the right word.
The sources detail that it hit a record of more than $1.1 trillion. But the exact peak reached a whopping $1.17 trillion in the third quarter of 2024.
1.17 trillion. That number is... It's almost hard to visualize. How fast did it grow? Can you give us some context on that?
The growth rate is astonishing. To put it in context for you, that same consumer debt stood at $770 billion in the first quarter of 2021.
$770 billion.
So in just over 3 years, credit card debt grew by approximately $400 billion. That's a roughly 55% increase in the debt held by consumers in a relatively short time frame.
Wow. So if you're a politician and you're looking at that $1.17 trillion number, you recognize two things. First, that a lot of families are using credit not for luxury, but for essentials, just to keep pace with things like inflation.
Absolutely.
And second, that every single percentage point of interest applied to that massive principal translates into billions of dollars of relief or billions of dollars of corporate profit. It's a crisis ripe for political intervention.
Exactly. When you have high inflation, so the price of goods and services is rising and wages aren't keeping pace, that gap between income and expenses is often filled by credit cards.
Right.
Now, pair that with the fact that credit card interest rates have simultaneously been very high. You create a vicious spiral where consumers are forced to borrow at high rates just to survive, and then they're trapped under mounting interest. That massive number gives you the context, the urgency driving the political action.
Okay, and here's where it gets really interesting on the political side. This whole 10% cap idea, it wasn't brand new.
Not at all.
The sources show there were bipartisan attempts to implement a very similar measure previously. This highlights that the political pressure against high rates has been building for years, making the president's announcement less of an outlier and more of a culmination of a deeply felt consumer issue.
The specific precursor policy battle is a great example of this. In February 2025, you had Senators Bernie Sanders and Josh Hawley, two figures from entirely opposite ends of the political aisle.
I mean, you couldn't find two more different politicians.
Right. And they introduced a bipartisan bill to cap rates at 10%, not just for 1 year, but for 5 years. That kind of consensus suggests that the issue of credit card debt, it really transcends traditional party lines.
So you have a unified front from a self-proclaimed democratic socialist and a highly conservative populist, both agreeing on the necessity of this radical market intervention. What was their rhetoric like?
Their reasoning was stated in very strong terms, which drives that extortion narrative the president later echoed. Sanders' comments were particularly strong. He argued that when large financial institutions charge over 25% interest, they are engaged in, quote, extortion and loan sharking, not simply making credit available at a fair price.
So they're not just providing a service.
In his view, no. They sought to provide what they called desperately needed financial relief to working families struggling to pay their bills.
So their argument fundamentally challenges the financial industry's entire model. They're saying the current rates aren't a fair function of economics or risk, but a function of predatory greed taking advantage of consumers who are trapped by high debt.
That's the crux of the proponents' view. They believe the market is structurally unfair and it needs a dramatic intervention, a ceiling, to stop the abuse.
Despite that powerful bipartisan push, I mean, Sanders and Hawley agreeing on anything is a major political event.
It is.
The result was legislative failure. The sources clearly state that bipartisan bill failed to progress in Congress due to major organized opposition from banking groups.
And that failure is a crucial detail here. It tells us two things. First, the banking industry has the political muscle to successfully block this policy through the normal legislative process.
Okay.
And second, it helps explain why the president might have chosen this executive announcement route this time. If Congress is blocked, the executive branch might attempt to bypass that legislative blockage entirely, even if the legal footing is, let's just say, shaky.
That is a perfect transition.
Yeah.
It takes us directly to the immediate fallout from the announcement. Because the political reaction wasn't just swift, it was deeply complicated. It immediately highlighted this deep, entrenched divide over regulatory intervention in consumer finance.
It was complex because the reaction wasn't purely binary. You didn't just have Democrats cheering and Republicans booing or vice versa. You had allies supporting, you had progressives doubting the sincerity, and critics focusing heavily on the lack of legality. It was all over the map.
Okay, let's start with the pro-cap support. Senator Josh Hawley immediately lauded the move. Having co-sponsored that failed bill, he stated on X, "Fantastic idea, can't wait to vote for this."
So his response confirms this is a consistent policy priority for him. For this wing of the political world, the method of implementation is secondary to the immediate financial relief that's being promised.
But the reaction from the progressive left was surprisingly hostile, which is crucial context for you to understand the politics here. Senator Elizabeth Warren, a key champion of consumer finance regulation and arguably the most prominent critic of high interest rates in the Senate.
The founder of the CFPB.
Exactly. You would naturally assume she would celebrate any measure aimed at a 10% cap, but she called the announcement a joke and a fraud.
Which is powerful. That's a powerful repudiation from an ideological ally on the issue of REIT capping.
So why? We need to understand why her critique was so harsh.
Well, she stated she would work to pass a bill if Trump were serious, but she noted he had done, quote, nothing but try to shut down the Consumer Financial Protection Bureau, CFPB.
Help me unpack that connection. What does the CFPB have to do with a credit card cap?
Everything. The CFPB is the agency specifically created to protect consumers in the financial marketplace. If you want to regulate a trillion-dollar industry, they are your enforcement arm.
They're the ones who would do it.
They're the ones who would do it. So Warren's critique centers not on the idea of the cap, but on the president's perceived sincerity and legality in pushing it. She's arguing that a president genuinely concerned with consumer protection wouldn't simultaneously try to dismantle the very agency designed to enforce those protections.
So she sees it as political posturing.
Exactly. She views the cap announcement as a move intended to deflect criticism of his administration's broader deregulatory stance.
Which leads to an incredible internal contradiction revealed in the source material regarding Senator Sanders. Just one day before the president's announcement, Sanders had criticized him publicly on X.
I saw that, yeah.
For not fulfilling his campaign pledge to cap rates and for continuing his general pattern of deregulating big banks.
The timing is impossible to ignore. It's just. Sanders accuses him of deregulation and inaction on Friday morning, and by Friday night, the president announces the cap.
It's a direct response.
It illustrates that the political landscape around this issue is highly complex. It's driven by internal political pressure, campaign promise fulfillment, and this frantic desire to seize the populist high ground on a painful consumer issue. It's less about coordinated policy and more about responsive political theater.
Okay, so if we move past the political motivations for a second and get down to the brass tacks of governance, the sources point out the absolute key vulnerability in all this. The president provided zero specifics on how the government would actually implement the cap or ensure compliance.
And when a policy threatens to overhaul a trillion-dollar industry in 10 days, the absence of an implementation plan isn't just an oversight.
No.
It's the reason the industry is, sort of laughing and panicking at the same time. This raises a massive question. Is this a policy mandate or is it just a political signal?
What specifically is missing in terms of the regulatory machinery? How does a government enforce a financial restriction of this magnitude?
Well, the standard regulatory mechanism is a formal rulemaking process that would be initiated by an agency with delegated authority, like the CFPB or the Office of the Comptroller of the Currency, the OCC, or maybe the FDIC.
Right, the usual channels.
The usual channels. Alternatively, it could be a formal executive order, an EO, that clearly states the authority being used, usually some kind of national emergency power or delegated authority under existing banking laws.
And we have none of that.
We have none of that. And that's why critics, including Senator Warren, express profound doubt that the president could legally impose such a significant, across-the-board financial restriction on all domestic lending without explicit approval from Congress.
It just feels like a massive overreach.
Well, credit card interest rates are traditionally regulated by a mix of state laws and federal banking rules. An executive announcement imposing a hard cap on interest across the board would immediately face a wave of legal challenges claiming constitutional overreach.
So the lack of a clear regulatory vehicle suggests the primary immediate impact of the announcement is political.
I think so. It seems intended to force a conversation in Congress or with the public, rather than being an instantly enforceable economic policy.
So the financial sector is essentially saying, we hear you, but until we see a signed EO referencing a specific legal statute, we have no mechanism to change our behavior.
Yeah.
But whether it's enforceable or not, the reaction from the industry was immediate and severe.
Oh, absolutely.
That's right. The financial sector did not wait for the legal documents. The immediate pushback was organized and forceful. America's credit unions, the ACU, immediately wrote to the president. And they argued quite explicitly that the cap would reduce access to credit and critically harm the very consumers it purports to protect.
And the ACU's involvement is a crucial layer here, because they market themselves as institutions that are inherently on the side of the consumer. They're nonprofit cooperatives designed to offer lower rates.
Which makes their opposition harder to dismiss as just corporate greed from, say, Wall Street banks.
Much harder.
So let's scrutinize their argument.
Mm-hmm.
The ACU president and CEO, Scott Simpson, he acknowledged the intent to increase affordability, but stressed the, quote, plain truth that capping rates at 10% makes credit unattainable for millions of working Americans.
Okay, so let's elaborate on their operational constraint argument because it really is the heart of the industry's objection.
Please.
Financial institutions, they just cannot offer credit cards to most consumers at such a low rate due to the realities of risk management. The interest rate is not pure fungible profit. A substantial portion of it is required to cover the expected losses from lending to consumers who default.
Okay, but I have to challenge this a bit. The ACU is fundamentally funded by credit unions. Aren't these warnings just self-serving? How do we know these predictions of cutting off 37 million people aren't just exaggerated lobbying tactics designed to scare consumers and politicians?
That is an excellent and a necessary challenge. And when we analyze any policy debate, we have to consider the source's bias, of course.
Right.
However, the ACU supports its claim by referencing the fundamental mathematics of risk pricing. And that's universal across all lending institutions, regardless of their nonprofit structure. The mechanism they cite, that if revenue cannot cover anticipated loss, the lending must stop. That's just mathematically sound.
So the question is about the scale, not the mechanism.
Exactly. The debate is whether the scale of the prediction, that 47 million number, is accurate, but the mechanism is generally agreed upon in finance.
Okay.
Furthermore, the credit unions made sure to highlight their unique position to try and lend credibility to their argument. They claim that they were founded as the original consumer protectors, and they already offer the lowest rates.
I saw that. They said their rates are often roughly half the average APR charged by other issuers.
And they emphasize their cooperative, member-owned structure is what enables those lower rates.
So they are essentially arguing, we, the good guys, are already lending as low as we profitably can. If you force the cap lower, even we will be forced to stop lending to the riskiest groups. It's an effective rhetorical strategy that uses their mission statement as proof of the policy's unworkability.
And their history matters too. They highlighted the ACU's successful past efforts against similar legislative attempts, including keeping rate cap provisions out of something called the Genius Act. This just demonstrates they are experienced and politically effective opponents of broad rate caps.
Okay, now we get to the core of the predicted economic fallout. The letter from America's credit unions provided 5 extremely specific, high-stakes predictions of harm. We need to go through these carefully for you, the listener, focusing on why these outcomes are predicted and what they mean for the average person.
We really do have to break down these 5 domino effects, focusing on the scale and the mechanism of the predicted disruption.
Right. What's number 1?
The first prediction deals with existing users, specifically those who use their cards as intended as a revolving credit mechanism. The ACU estimates that 2/3 of credit card users who currently carry a balance would have their credit lines reduced or entirely eliminated.
2/3 of balance-carrying users. That is a truly staggering figure.
Yeah.
Because those are the people who are already struggling, relying on that revolving line for month-to-month cash flow. So what's the mechanism for this reduction?
Lenders, upon implementation of the 10% cap, would be forced to instantly reevaluate the risk profile of their entire portfolio.
Right.
If the maximum interest they can charge, which is the price of the risk, is suddenly cut by more than half, they have to reduce the amount of risk they hold. And the fastest way to reduce risk is to reduce the potential principal they can lose.
So they just cut your limit.
Therefore, if you are carrying a balance and thus showing high utilization and a higher risk profile, the lender would immediately slash your credit limit or even close the account entirely to minimize their exposure under the new pricing cap. This doesn't solve your debt problem. It just removes your financial safety net.
That reduction is bad enough, but the second and perhaps the most devastating prediction concerns the subprime market. The ACU states that virtually all of the 47 million Americans with a subprime credit score would be unable to obtain or keep a credit card.
47 million people. This isn't just a number, it's a massive, economically vulnerable segment of the population. And to truly appreciate this prediction, we should probably briefly define subprime.
Please do.
Yeah.
What defines that cohort in the eyes of a lender?
Generally, a subprime borrower is categorized as having a FICO score below 620. This cohort often consists of individuals who have experienced a previous bankruptcy, defaulted on loans, missed multiple payments, or just have very little credit history.
So they're considered high risk.
Very.
Yeah.
Because of this history, The default rate, the percentage of these loans that go completely unpaid, is significantly higher than for prime borrowers. They are precisely the group why rates are high in the first place.
I see.
So the prediction is clear. If the lender cannot price that high risk, where the expected loss rate might be 15%, 20%, or even higher at the 25% to 30% APR they currently charge, they will simply refuse to lend at 10%. Lending at a loss is not a sustainable business model.
So the policy, intended to protect the vulnerable by lowering the price, would immediately exclude 47 million vulnerable people from the mainstream credit system entirely.
The economic reality is unforgiving here. If the price of risk is capped below the actual cost of that risk, the lenders simply cut off the risky customers.
Precisely.
Okay. What's the third predicted harm?
The third one addresses how institutions would attempt to cope with the sudden loss of interest revenue from the consumers they do keep. The ACU warns that lenders, including the credit unions themselves, would have to raise fees or launch new service charges to cover costs and manage risk. So the costs don't disappear, they just get repackaged.
Exactly. I mean, if the interest income stream, which is the traditional, most transparent way to price risk, is cut off, lenders have to find new sources of revenue to maintain solvency and cover their operating costs.
And those costs are just pushed onto other parts of the consumer relationship.
Right, maybe through annual fees, balance transfer fees, foreign transaction fees, or higher late payment charges. The consumer still ends up paying more, but in a less visible, less transparent manner than interest. So the net financial benefit to the consumer might be zero or even negative, depending on their usage patterns.
The fourth impact moves beyond the financial institutions and into the broader retail economy. The ACU warns that Main Street retailers and small businesses would see sales decline as customers lose card access or have lower limits.
Yeah, think about the real economy impact of that. Credit cards are the engine of retail spending, especially for those consumers who rely on them to bridge income gaps. If 2/3 of balance-carrying users suddenly have their limits drastically lowered, or if 47 million subprime users lose access entirely, that translates directly into lower sales for the local bakery, the hardware store, the independent mechanic, or online small businesses.
This isn't just about debt, it's about consumer liquidity, the money that keeps the economy moving.
And that leads directly to the fifth and broadest prediction: economic contraction.
Okay.
The ACU argues that less access to credit for specific groups, and they specifically named key demographics like teachers, small business owners, members of the military, and farmers,
Right.
would create a contraction in consumer spending that harms the broader economy. These groups often rely on credit cards for working capital, unexpected large expenses, or just smoothing out the variable income cycles inherent to their professions. Cutting them off affects productivity and overall economic output.
So the underlying argument here is that the cap would actually be a recessionary force.
Yeah.
It would starve the economy of necessary consumer liquidity, particularly for those who drive essential everyday spending.
That's the fear.
It's crucial to emphasize that this alarm bell wasn't just ringing from the credit union community. The opposition was universal across the entire massive banking sector.
And that level of unity is rare. It really speaks volumes about how fundamentally disruptive the industry perceives this 10% cap to be. A joint statement was issued by a major coalition of banking groups,
Right.
encompassing the Bank Policy Institute, the American Bankers Association, the Consumer Bankers Association, the Financial Services Forum, and the Independent Community Bankers of America.
So that coalition covers everyone. The largest Wall Street institutions, major credit card issuers, regional banks, and the small-town community banks. Their consensus is unanimous.
And their consensus warning mirrored the ACU's points exactly. They stated a 10% cap would severely reduce credit availability, be devastating to consumers, and critically drive consumers toward, and this is their phrase, less regulated, more costly alternatives.
And that is a shared fear across the entire legitimate lending ecosystem.
It is. The fear is that removing the regulated high-interest option simply creates a vacuum that predatory, unregulated shadow lenders will immediately fill.
And those shadow lenders, we're talking payday loans, title loans, things like that,
Exactly.
they often charge rates far, far exceeding 30%. So the consumer would be moving from a system that is at least regulated to one that operates entirely outside of federal banking oversight.
It creates a worse scenario for the consumer. I mean, the irony is that the policy, which is intended to eliminate what its proponents call extortion, could end up pushing consumers into lending scenarios that are objectively worse and far less regulated.
Even a prominent Trump supporter weighed in with a specific economic critique,
Yeah.
which demonstrates that this policy cuts across political loyalty when the financial math is involved.
Right.
We're talking about Bill Ackman, the billionaire hedge fund manager.
Yeah.
His public reaction was fascinating because it really highlighted the political tension.
It did.
He initially posted a strong opposing tweet that was immediately deleted, then reposted a more measured concern. The deletion suggests he was navigating the political pressure of criticizing a sitting president he supports while still needing to communicate an economic reality.
And his core concern was purely financial and highly specific. Ackman worried that the cap would inevitably cause millions of Americans to have their cards canceled because lenders would lose the ability to, quote, adequately price subprime credit risk.
So he gets the goal, but not the method.
He agreed that the goal of reducing interest rates was worthy and important, but the 10% cap was fundamentally the wrong tool to achieve it.
This brings us back to the central economic reality that the banking groups are highlighting. We need to dedicate some time to truly understanding this concept of risk pricing, because it's the key to the entire deep dive. Why does the industry need rates above 20%?
Okay, think of it this way. Credit card companies are essentially insurers against non-payment. When they lend you money, they are making a bet that you will pay it back, plus interest.
Oh, bet.
But they know, based on decades of data, that a certain percentage of their borrowers, especially those in that subprime cohort, will default. That results in a 100% loss of the principal loan to those specific customers.
So the interest paid by the customers who do repay has to cover a lot more than just profit.
It has to cover not only their operating costs, customer service, technology, anti-fraud, and profit, but also all the losses incurred by the customers who don't repay.
Right.
Let's use a simplified analogy. If a lender projects that 15% of the money they loan to subprime borrowers will be completely lost, that's their expected default rate.
Okay, 15%.
And they have another 5% in administrative costs. They have to achieve a gross yield of at least 20% just to break even. Now, if they want a modest profit margin on top of that, they might charge 25% or 28%. That extra margin is their compensation for taking the risk.
So if the maximum price, the rate, is capped at 10%, that entire insurance model just collapses.
Precisely. If the lender anticipates a 15% loss rate, but can only charge 10% interest, they are locked into an automatic 5% loss on every single dollar they loan to that high-risk cohort. And that's before even covering their own operating costs.
The business model instantly collapses for that specific segment of the market.
The only rational fiduciary response for the industry is to eliminate that loss exposure by cutting access for that entire cohort of people.
And that mathematical reality is why the prediction of 37 million people being cut off is not seen as hyperbole by the financial sector.
No, it's a straightforward, unavoidable outcome of risk pricing dynamics. The interest rate is the price of the risk. If you cap the price below the cost, the riskiest customers become too expensive to serve, period.
It seems like the political argument that rates are pure extortion runs headlong into the economic argument that rates are indispensable risk management tools.
And in a high-debt, high-risk environment like the one we currently have, the economic reality is unforgiving, regardless of the political intent.
That conflict is the defining characteristic of this whole debate. It's an ideological war between consumer protectionism and market realism.
It is.
So given the universal opposition from the financial industry and these dire specific warnings of cutting off 47 million people, the question naturally arises. Is there a middle path? Are there better ways to achieve the goal of consumer relief without risking a catastrophic contraction of credit access?
Well, the industry, sensing the political pressure, was careful not just to say no. Instead, the ACU proposed a focus on targeted, data-driven solutions that truly help consumers in need without negative side effects. And this is a crucial pivot point.
Okay.
They are offering counter-proposals that focus on managing the demand side of credit, so consumer behavior, and assisting existing debtors rather than crippling the supply side, which is the lending mechanism.
Okay, but I have to play devil's advocate here. Are these proposed solutions, financial education, debt counseling, are they sincere? Or are they just a stalling tactic? If the banking industry was genuinely interested in solving the debt crisis, why didn't they aggressively implement these solutions years ago when the $1.17 trillion debt crisis was building?
That skepticism is warranted. I mean, when the industry proposes education as an alternative to regulation, the public often sees it as shifting the blame onto the consumer.
Right. It's your fault you're in debt.
Exactly. But we have to evaluate the proposals on their potential efficacy, not just the motivation of the source. These alternatives aim to heal the system slowly, whereas the cap aims to force change immediately.
Okay, so let's walk through them. What are the specific suggestions from the ACU?
First, they suggest supporting financial education and budgeting resources. This aims to reduce the debt problem by improving consumer decision-making, helping people understand how interest accrues, and preventing them from entering high-interest debt cycles in the first place.
But how effective is that really? I mean, if a consumer needs credit to pay for a necessary car repair because their income is too low, no amount of budgeting education changes the fundamental income-to-expense ratio.
And you've just raised the core criticism of this approach. Education is a long-term solution to what are often structural economic problems. It doesn't offer immediate relief to the consumer who is buried under $10,000 of high-interest debt right now. However, the industry argues that poor financial literacy often exacerbates the problem, leading people to accept terms they don't fully understand or utilize credit in ways that quickly overwhelm them.
Okay, what's the second proposal?
Expanding access to nonprofit debt counseling. Now, this is a crucial mechanism for helping people who are already deep in debt to restructure their payments, negotiate lower payoffs, and get professional assistance without punitive measures.
That seems like a more immediate, hands-on intervention than just education.
It is. Debt counseling, if it's properly funded and executed by nonprofits, focuses on managing the existing crisis. It's about providing a lifeboat rather than preventing the ship from sinking in the first place. This approach targets relief precisely where it is needed on the most distressed borrowers without forcing a change in the risk pricing structure for everyone else.
All right, what else?
Third, they suggest encouraging refinancing opportunities for high-interest debt. So instead of cutting off credit, this helps consumers move their existing expensive debt burden into lower-rate products, like installment loans or secured loans.
Which reduces the overall interest paid over time without forcing the credit card issuer to fundamentally change its risk model.
Exactly. It keeps the high-risk credit card market operational for short-term necessity, but encourages a switch to a more financially responsible long-term product for large balances.
Makes sense.
The industry acknowledges that once a balance becomes large and permanent, it should ideally be moved out of the revolving credit system. Refinancing helps facilitate that transition. And finally, the ACU promotes the availability of lower-rate credit options, specifically referencing options like those already offered by credit unions.
So they're basically saying, let us do our thing.
This proposal leverages existing cooperative, lower-rate market structures as the solution, rather than imposing a regulatory restriction on all lenders, regardless of their structure or mission.
So the debate truly boils down to two distinct philosophies regarding consumer debt management. Is the solution a massive, immediate regulatory hammer to force prices down the 10% cap, which carries the high risk of excluding 47 million people from the mainstream financial system?
Or is it a set of tailored programs designed to improve financial literacy, manage existing debt through counseling and refinancing, and promote existing lower-rate market options without destroying credit access for those who need it most?
Yeah.
The sources show the policy debate is highly polarized between these two approaches. It's a classic tension between speed of relief and stability of the market.
And the risk-reward profile is just crystal clear. The cap promises immediate high-profile relief, but threatens massive, specific, and immediate unintended consequences by cutting off the most vulnerable borrowers.
While the targeted solutions offer slower, perhaps less politically satisfying relief, but they aim to heal the consumer finance system without collapsing the entire apparatus of risk pricing.
And the political question is whether a politician facing re-election or campaign pressure can afford to choose the slower, quieter solution over the immediate, high-impact promise.
Right.
So what does this all mean for you, the person trying to make sense of this financial earthquake? We have a high-profile, high-impact policy announcement targeting massive consumer debt, a problem evidenced by that crushing $1.17 trillion debt peak back by political figures who see high rates as unmitigated extortion.
We also have a unified financial industry, from the largest banks to the consumer-focused credit unions, warning that the policy is fundamentally unworkable under current economic dynamics.
And their key prediction?
Their key prediction is that it will hurt the very subprime consumers it aims to protect, potentially cutting off credit access for 47 million Americans who rely on it, however expensive it might be.
And if we connect this to the bigger picture, regardless of the cap's legal fate, or whether that January 20th deadline is even hit, the sources highlight that America's consumer finance system faces profound systemic stress. The conversation isn't just about the rate, the numerical price of interest. It's about who bears the risk.
Exactly. Does the consumer bear the risk through high interest payments, or does the lender bear the risk through loss?
A fundamental question.
And crucially, that calculation, that delicate mathematical pricing of risk, ultimately determines credit accessibility for the most financially vulnerable in our society. The 10% cap proposal has stripped away all the political rhetoric and exposed the ugly truth that for millions of Americans, the only credit available is expensive credit.
Because the risk is just too high.
Because the risk of non-payment is simply too high for mainstream lenders to absorb at a lower price.
This whole deep dive just shows that sometimes the solution that sounds the simplest, just cap the rates,
Yeah.
has layers of complexity and unintended consequences that manifest almost immediately in the form of unified institutional resistance and these powerful predictions of market collapse. The immediate cancellation of cards for 47 million people is a powerful deterrent against implementation.
So as you consider the source material, here is a final provocative thought for you to mull over. If a 10% cap were somehow implemented, and it does lead to those millions of card cancellations, who steps in to fill that immediate high-risk lending gap? What would those unregulated, more costly alternatives referenced by the banking groups truly look like? And what new dark market could emerge, one outside the reach of the credit unions and regulated banks, if mainstream finance officially retreats from serving those 47 million people?